mutual fund or index fund, like an exchange traded fund? Which one is better for your money? One typically is actively managed and tries to beat the market averages, and in exchange for their services, they charge a slightly higher fee. And the other doesn't try to beat the market averages at all and charges a much lower fee. Now, over the course of an average lifespan of an investment, say 20 to 30 years, one of these two vehicles could potentially leave you with hundreds of thousands of dollars less in your pocket. So we should take a closer look. Hi, I'm Noah Davidson with the Cashflow Academy, and I've been a dedicated student of the financial markets. And over the last 2 decades, I have helped countless people just like you make smarter decisions with their hard-earned money. And in today's video, we're going to answer some pretty typical questions. I've received a lot of questions like this over the years from our students, and they've asked me a lot of questions like, well, why are my fees so high? Or why is my account barely growing when the market is performing well? And by the end of this video, you'll have a pretty clear understanding of which one of these two investment vehicles or these types of funds our students prefer and why. So here's what we're going to discuss in this video. We're going to unpack what mutual funds are and how they work, and what index funds are and why they are different. And we're going to be discussing how fees really impact your returns over time. Then we're going to break down and identify the type of fund that has quietly helped thousands of our students grow well with a lot less stress and much more effective compounding. Let's start out with what a mutual fund is. A mutual fund is actively managed. And what that means is that a professional is picking the investments for you, and they're usually trying to outperform the market. Now, there are some mutual funds that are conservative, for example, and they're taking less risky picks, not necessarily trying to beat the market, but reduce risk. So there's different types of mutual funds, but a lot of mutual funds are trying to advertise their picking prowess and their ability to potentially beat those market averages. But the thing you need to really consider with mutual funds is that the average mutual fund charges somewhere around 1 to 2% in annualized fees. And according to the S&P SPIVA, S-P-I-V-A, the SPIVA scorecard, over 85% of mutual funds underperform the market over an average 10-year period. And that doesn't mean that the mutual funds are bad, but it does make you wonder, why are you paying for less performance? An index fund takes a different approach. Instead of trying to beat the market, it simply mirrors it. It tracks the major benchmarks like the S&P 500 or the NASDAQ 100, and it has all the same holdings, all the same companies, and there is no active manager. And because of that, it's just a low-cost structure that keeps things simple and steady. Most index funds charge as little as 0.03% or 0.05% or even 0.5%, which is a lot less than your average mutual fund typically costs. And historically, they have outperformed the vast majority of mutual funds, especially over long time frames. Let's give you a really simple example using big fat round numbers to make it simple, to help you understand the power that fees have on compounding over time and really make this decision very easy and clear for you to make. Let's imagine for a moment that you started out with a $100,000 investment over the course of 30 years. Now, if you don't have $100,000, that doesn't matter. You can start out with whatever you have, $1,000, $10,000. The math breaks down pretty much the same over time. But if you imagine $100,000 over, say, 30 years, and you look at market average returns over the last 100 years, and it's somewhere in the ballpark around 8%. Now, some years perform better than others, and there are variations to this, of course. But if you have an investment vehicle with no fees and an average of 8% gains or compounding per year over the lifespan of an investment of around 30 years, that $100,000 can turn into over $1 million, about $1,006,265 to be exact. An index fund with a 0.05% fee would compound over time. And the benefit you get from that is the automatic diversification, and it mirrors the market by tracking the exact same stocks in the index fund. It would compound over time to about 992,383 to be exact. And the mutual fund that's actively managed and charges about a 1.5% fee, kind of right there in the middle between a 1% and a 2% fee, which is average or typical, that would compound over time over the same 30 years to about $661,437 to be exact. That's a difference of over $340,000 from just the fees. It doesn't matter what stocks they pick or their timing of the market. That is just the fees over time. The difference between an 8% return on average for the market versus a 6.5% return once the managers extract their fees. And so when I show these numbers to our students, the most common response I hear is, I had no idea. I had no idea it makes such a difference. So which is best? The answer is kind of obvious, but every investor has different goals and they have different comfort levels. But if we look at just the raw data and the feedback I've gotten from students over years and years and years of having this discussion, it's kind of a simple decision to make. Now, does that mean that mutual funds never make sense? No, of course not. But it is worth asking. If the majority of mutual funds don't outperform the market and they charge you for the simple effort of attempting to beat the market or for simply actively managing the fund, is that a trade-off you're willing to keep making? Now, only you can answer that question, but now that you've seen an example of how the numbers work out and how it extrapolates out over time, it's kind of a no-brainer. So now that we've broken down and compared and contrasted a mutual fund versus an index or exchange traded fund, and we've seen the difference between the two, here is something else for your consideration. Even if you have the best mutual fund in the world that actively managed beats the market averages over time, it won't help you as much as you think when you go to retire if when you withdraw the money you get hit with a tax bill that eats up a huge portion of your gain. That's why I made a separate video to show you the power of using a Roth IRA to help you protect and shelter your growth over time from the tax man. It could be the most profitable video you ever watch, and it's only about 10 minutes long. So make sure you click on that link to watch that video. If this video helped clarify things for you and we made it easy to understand, make sure you hit that like button so that the YouTube algorithm knows to share this video with other people so we can help them as well and continue to build our community. And don't forget to hit the subscribe button and the notification bell so that you can receive notifications when our future video content is released. And if you have experience with mutual funds or exchange traded funds and you're aware of the fees and you want to share your opinion with us, that would be awesome. Go ahead and put those comments below in the comment section. We'd love to hear from you. And of course, as always, let's keep learning and growing together, because the more we learn, the more we can earn.